Good morning, everyone. Joost van der Zee, Chief Strategy Officer at Wereldhave. And together with my team, we're responsible for the strategy, of course, and all the strategic projects, and the transactions and data and analytics that we do. Joined Wereldhave in 2020 after having worked as a strategy consultant for 7 years. And my last project was the development of the new strategy for Wereldhave. Work on strategy, of course, all the strategic projects, transactions, and all the data and analytics. Especially also the sales data that we get from tenants. We get more and more. Peter will tell you more about that later, and I will show you what we do with it. I joined in 2020, April 2020, so just after COVID hit. Yesterday, I think we had the talk that I just joined when our share price was at the bottom, I think €6. So it doubled since then, more than doubled since then. And before joining Wereldhave, I worked as a strategy consultant, and my last project was actually the development of the new strategy of Wereldhave. So after making only plans for 7 years, I made the switch to actually doing something and executing the strategy of Wereldhave. So Matthijs already said, in 2020 we presented the LifeCentral strategy. 3 phases, but good I think to mention also is what is at the heart of our full service centers, and that's that we want to fulfill all daily life needs of our consumers. So we identified 4 need areas which consumers want to fulfill every day, and our tenant mix is formed around these 4 need areas to make sure we serve all them. So it's fixing the basics, it's basically doing groceries, going to drugstores, homeware, household things. It's self-expression, which is more around fashion and nice things for your house. It's enjoying life, which is more about F&B, and it's well-being, so the fitnesses and the personal care. So the focus of the full is much broader than only retail. If you then look at physical retail, because we always said we want to transform to mixed use because we expect physical retail to perform poorly in the future. That's what we expected when we developed the strategy. But if you look, what actually happened is that physical retail is performing much better than we expected. On the left side of the chart, you see our expectations on floor space reductions when we developed the strategy. That's in green, and in orange you see what actually happened. So we expected the floor space, for example, of multimedia electronics in the Netherlands to come down by 22%. So we prepared our blueprints, so the future view of our assets, based on these expectations. But we actually see that only 10% decrease of floor space for multimedia electronics. For fashion, same pattern. We expected 18%. It turned out to be 8% over the past year that it decreased. If you look at groceries, for the Netherlands, we expect it to stay flat, the total floor space. That went actually up by 5%. One of the drivers, in Belgium basically you see the same pattern. One of the drivers of this better performance of physical retail is the worst performance of e-commerce. So we, in the graph there on the blue line, you see what we expected during the development of LifeCentral, how the penetration of e-commerce will develop. And the red line is what actually happened and what the latest forecasts are. So you see that e-commerce got a big jump during COVID, of course, but it went back to the levels before COVID, of course driven by the high interest rates, and many of the e-commerce companies are still loss-making. So banks are not willing to lend them money anymore with the current interest rates. But it helps for us for the physical retail, because online, I will get to you, online is having difficulties and it's growing less fast than we expected.
What are your views going forward?
So I think that physical retail will perform good as it's doing it now. What we already see that there's more and more polarization. So the good ones are doing better and the bad ones are now gone. Basically, Big Bazaar, it was on red in our blueprints for a long time, now went bankrupt. So we see at the bottom of the market that there is like a shift going on, and there's some of the parties are falling out of the mix. But on the good performing tenants, they're very good and they're still expanding. If you look at the bestseller or New Yorker, our fashion chains, Peter can tell you more about it, they're still expanding, and we expect it to continue like that. Yeah. But not only in the market, physical retail did a good job, also in our centers they did a very good job. So on the top left you see the percentage of floor space that we put on red. So basically what we say, if we put something on red, we expect those tenants to leave within 5 years. So we expect vacant space there. When we did the strategy in 2020, we expected 30% of the floor space to become vacant. If we look now, that's only 21%, and this is for the not transformed assets. So it's not that we kicked out the bad tenants and we replaced them with good tenants or with mixed use. No, it's the ones where we didn't transform yet. So also in those centers, physical retail is performing better than expected. And you also see it back in the rent levels. So those are for the full service centers, so for the centers that we transformed. In 2019, the rent was at 218 per square meter. We expected it to go down to 214, but if you look now, it's at 220. So rent levels are better than we expected. And that in combination with the stable occupancy and the significant cost saves that we did, we were able to outperform our trough EPS that we expected for last year. We were around 20 cents above that. So I think we did much better than we expected during the development of the strategy. Matthijs already talked about the transformation of our assets. So far we have delivered 6 and 3 more we will deliver this year. So you see Sterrenburg on there, we will visit this afternoon, and Kim will tell you more about it. And the Koperwiek, which is almost finished, we will deliver by the end of the year, and Doris will tell you more about it in the afternoon as well. There you see our IR framework. So we're very strict on this framework. So for each asset we calculate the IR each year again. We look at the expected rental income, the capex that's needed, the maintenance capex, the development capex, the commercial capex, everything goes in there. And if it's not meeting the threshold, it will put in the hold bucket. And when it's really below the threshold, it will put in the sell bucket. It was at 6%, the threshold. We raised it to 7% already last year. And we will do another review in the coming months. We just made all the business plans for all the assets, and based on all those outcomes, we will recalculate the IRs. And also, most probably, increase the threshold to maybe 8.5%, because you all know rents went up, so we also need to increase the thresholds here. To design the full service centers, we use a very thorough approach. We start always with setting the foundation. That's basically what we did during the strategy. We review it every year, but it stays kind of the same. So we said, okay, what are the key anchor tenants for our centers? What are the types of mixed use that best fit our consumers, best fit our locations? And that's the starting point. Then we do an asset by asset assessment. We look at the performance of the asset, so the NPS, it's basically the consumer satisfaction on the asset. We look at the footfall, we look at the sales from our tenants, and we go tenant by tenant to see how viable this tenant is or not. And that results in a blueprint, which is our future view of the asset, and a business case and the IRR calculation. Important step in there is the red flag analysis. That's basically a data-driven assessment of the viability of a tenant. So we ask ourselves the question, will this tenant be there in 5 years, yes or no? And we base that on the sales data that we receive from the tenants and their payment behavior. So if their OCR, so the occupancy cost rate, is basically everything they pay us divided by their turnover, it's above a threshold. So for each category, we set a threshold like, okay, this between these two numbers, it's healthy. When it's above, it's unhealthy. When it's below, there are opportunities to increase the rent because they are doing a very good shop and they could afford a bit higher rent. When it's above the threshold, we flag the tenant. If the sales delta, so the sales this year compared to last year, is worse than -5%, so when they are at -6 or -10% compared to last year, we flag it, and when they have more than 3 months of payments outstanding, we flag it as well. This is the data-driven exercise. Then Peter and Doris from the leasing team come in. We review all the flagged tenants with them, and they decide like, okay, yes, it's flagged, but we know this tenant is doing very well. Of yes, we agree on the flag that you did, and we give it a green or red flag. When it's red, we expect the tenant to leave it in 5 years, and that's what we take as the basis for our blueprints. So on the bottom you see, of course, a very simplified map of a center. You see we have red and green tenants, and then we're going to sit together and, okay, how are we going to solve the red tenants? What are the other things that we will do to the center? And then we have the future view. And this future view is kind of the guidance for the leasing team, the asset management team, the development team, because they exactly know what are we going to do with these tenants. And also in cases of bankruptcies, Big Bazaar already mentioned, we just look in the blueprint, it was on red, we already have alternative plans in the blueprints, and the leasing team can go out and search for the right tenants to make sure we stick to the blueprint. So those things don't come as a surprise anymore for us when tenants go bankrupt or tenants leave. Same slide as Matthijs. They're outperforming the full service centers, so on all KPIs, and we believe they will continue to do so. Some of the full service centers are just delivered, so we expect more to come. And Doris and Kim will give a bit more different KPIs on the full service centers that we see in the afternoon. One of the drivers of the business case of the full service centers is yield compression. So when we presented the strategy, we expected between 50 and 75 basis points of yield compression on the transformed assets. If you look in the graph below, this is from our half-year presentation, you see that not for all of the assets we are getting the yield compression yet, but if you compare it to the yield development in the market, we are clearly achieving our target of 50 to 75 basis points compression on the yields. So also evaluators are seeing that the full service centers are less risky, a better future-proof product than a normal shopping center. And that is partly driven by the increase of mixed use and daily life retail. So we call daily life retail are the groceries, the drugstores, the discounters. So basically all tenants that are more or less vulnerable against economic downturn, they are less vulnerable for e-commerce growth. People will still come there no matter what happens. You see it grew a lot over the past years. In our blueprints it will grow even further. If you look at mixed use, also steady growth over the years, still a way to go. What we see there is that we do more fitness, more healthcare than we expected. But overall, it's a bit lower than what we presented in 25 during the LifeCentral presentation. There we said it will be 25%. So now, because of the better performance of physical retail, we see less urgency to replace the physical retail with mixed use. So it went down to 20%, but we think still the right amount in our centers to make sure that consumers have enough reasons to come to our centers and we can still serve all the daily needs. When we said that we're going to transform to mixed use, a lot of the expectations were that rent would go down because everybody thought like, oh, a very well-paying fashion tenant, you're going to replace it with a bad-paying fitness or healthcare operator that will have a bad impact on your rent levels. But what we see in reality, that's not the case. And there are three reasons for that. So the first reason is that with the mixed use, we are actually replacing underperforming or bad-paying tenants. So on the left side, you see an example from our Eggert Center in Permanent. There we had a sports world on the top right corner on the first floor. That already replaced the bankrupt V&D. We put a sports world in there. They were bad performing. They didn't pay rent for a long time. They went bankrupt. So basically, there didn't come any money out of that unit. Replaced it with a basic fit and a solo. Together paying more than what we got before. And attracting a lot of new, especially young people to the center that came to the basic fit. On the right side, you see our Shopping One center in Genk. There we had a Carrefour, hypermarket, badly performing, not attracting enough people to the center, and not paying well. When they left, we split the entire unit in several units. First, we put it in Albert Heijn, smaller than the Carrefour hypermarket and the Medi Market, so both daily life retail. And in the middle part, we created an F&B cluster according to our Eat and Meet concept, which you will see in the Koper Week this afternoon. And we created 6 F&B units there. Altogether, bringing us more in terms of footfall, but also in terms of rent than the Carrefour hypermarket was doing before. Second reason is that we filled up vacant space, or we better used the space. So on the left side, you see our Precinct Haaf. That was our first full-service center in the Netherlands. We had struggles in the middle of the center, on the right side of the center. So what we did, we took the Albert Heijn, which was on the top left corner where now is the Co-op. We put it on the right side. In the former HEMA unit. We put the HEMA in the center to make sure people were going there, and we put a co-op in the Albert Heijn. Then next to the co-op there was a passage and there were empty units. They were very hard to let, so we closed the passage and we transformed it into a healthcare cluster. So here you see that those units were vacant, we couldn't let them, we transformed it into a healthcare cluster, and that gave us a lot more rent than it did before. Right side, Kopervik, where we go this afternoon. We had this very hard to let unit at the back side because this is the passage, this is the outside. So for traditional retail, very hard to access, to enter. Behind some of our fresh units, and we put in a basic fit there. Again, vacant before, hard to let, put in mixed use, and it's a very well running basic fit now. Last reason, and maybe the most obvious reason, they are paying more rent than we expected. So when we developed the strategy, we thought that F&B, for example, would pay around 160 euros per square meter. So it was not our own expectation. We checked that with our brokers, with Cushman, with CBRE, and they looked in the market and said, okay, this is what you can expect. But actually we see they pay around 250 per square meter. Same for fitness, we expected 70, they're paying 100, and healthcare also a bit higher than we expected. So you're not only filling up space that was underperformed before, was vacant before, but also we're just getting more from the tenants than we expected.
And the duration of the contract?
It's longer, especially for a basic fit. They sign for, look at 10, 15 years, I think. So healthcare even longer. So it's very stable tenants. And that's also why we believe that the yield should come down, because we put in tenants that are less vulnerable for e-commerce, for economic downturn, but also with longer term contracts. So I had some conclusions. I think everything is covered. So physical retail is performing better than we expected, both in the market, but also especially at the Wereldhave centers. At the end of this year, we will be passing the half of the transformations. We have 9 full service centers delivered. Mixed use and daily life continue to increase, and rents are not going down because of the transformation to mixed use. They're actually going up. And this will also further drive better than expected IRRs. And as said, we will increase the threshold, so it might be that some of the project will fall into the hold or maybe even sell bucket again. Questions?
What explains the gap between your initial estimates, especially for F&B rents, for example, but you also still see today in your numbers that it's the renewals are way above ERVs, for example?
Yeah.
How come?
So I think one thing, of course, is the indexation of the rents. Those rents are indexed over the past years, and we didn't expect the high indexation that we got. But also they are just performing better than we expected. And during COVID it was difficult, but I think especially F&B after COVID, they all wanted to open new stores. Now it's a bit more difficult. But it's also the performance, and they see in our shopping centers that they got a lot of footfall, a lot of people are coming there, so they can also afford those rents. So I think it's a combination of indexation and good performance. One last question? No? Oh.
Yes, in fact, you did a good job. That's nice, but it's finished now. Should quit the company now, or do you have another plan? Or
No,
can you tell us?
all the things that Matthijs was talking about and the exercise we're doing for phase 2 of the strategy, I think there's a lot to come yet.
And you will tell that today?
I'm not telling it, no. Next year, maybe, we are telling it.
Thank you.
Thanks. Over to Mart, right?